Hello everyone, how's it going? In this video, we're going to be talking about Mullen, trading under the ticker symbol MULN. If you like my videos, please like, comment, and subscribe to my channel for more stock videos like this. Mullen stock has been trading around 50 cents over the past few days, marking a decrease of around 10% over the past week and around 17% over the past 30 days. It's hard to say whether the company will find enough steam to recover much or if any of its lost territories over the next couple of days or weeks. But Mullen, we have to say, has really been trying in various ways to cling on whatever market value it has left. And so far the results have been mixed. On one hand, the company succeeded in holding on to 50 cents, which, given the weakened stake of the company, the very negative or unfavorable sentiment, as well as the market sloppiness, it is already a feat by itself. Meanwhile, the company continues to struggle due to its own fundamental issues, as well as the lack of trust in Mullen's upper management. Now, let's also take a look at the technicals of the stock. The trading volume of Mullen has recently been around 54 million shares, versus an average of around 66 million shares. Over the previous 52 weeks, its price fluctuated between 39 cents and $137.25. The volume of shares traded tells us how many shares are being bought and sold at any given point in the market and if there's enough liquidity to support a trading strategy. If the float is thin, it would be very easy to influence the stock price, but low liquidity could mean that the demand is limited as well. When we compare the current volume against the average volume, there might be the possibility for trend reversal or breakthrough if the difference is very large. For instance, if the stock were to break through, the current volume would be significantly higher than the average volume. The market cap of Mullen is currently around $94 million, versus an enterprise value of around $17.3 million. As we compare the current price to the historical price fluctuations, the stock is 22% higher than the 1-month low, 22% higher than the 3-month low, and 22% higher than the 52 weeks low. On the options market, which gives a hint of market sentiment on where the stock price could go next, the implied volatility is 247% versus a historical volatility of 221%. The put-call volume ratio is currently around 41%. It is normal for many stocks to have a higher put option volume than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 44,000 contracts a day, versus the 30-day average of 34,000. In terms of open interest, the most recent volume of open interest is 1.1 million contracts versus the 30-day average of 1 million contracts. Regarding the shareholder structure, institutional shareholders own about 9% of the company, likely as a result of short selling of its outstanding shares. The biggest shareholders include Vanguard, BlackRock, and iShares. It's always good to see some institutional participation when holding a stock long-term, as it offers a layer of stability and a token of reliability in the medium to long term. It means that the market is confident that it can deliver value in the long term, which is a very important factor to consider for the investors. I personally consider the minimum threshold to be around 30% for institutional ownership. There are many exceptions to this rule, of course, as there will always be great companies mostly owned by retail traders. The current short interest is around 15% of the total float, and 52% of the transactions are coming out from the dark pools. Usually, if the short interest is above 15% of the total volume, with a significant portion of the short volume coming out from the dark pools, it may suggest that there are institutional positions taken to short the stock, and there could be potentials for a short squeeze. Now, with 15%, I would say that there is an argument for significant short presence, but not significant enough to argue that a short squeeze must be one of the key reasons to buy Mullen. Generally speaking, in the world of finance, penny stocks like Mullen are a bit unusual and also intriguing at the same time. Those securities are known for being cheap and get a lot of attention from retail traders or regular people like you and I, but they also tend to have very big price swings. Their movements don't often make fundamental sense. At the moment, a bunch of things are affecting the stock market. One important thing is the interest rate. When central banks raise interest rates, it makes it more expensive to borrow money, and that can slow down the spending by regular people and how to invest. For penny stocks, it might mean that people start to expect less from them or to think less of them, and some might even decide to not take these kinds of big risks for the time being, which can explain why penny stocks, especially the really risky ones like Mullen, have been losing value recently. This situation can also lead to prices going up because of inflation. Some people might want to invest in riskier things like penny stocks to try to make more money than what they're losing because of the rising prices. But this might not always work out, and it doesn't have a big impact on where most of the money the market goes to. Big investors usually wait for prices to drop significantly before they start buying again. Also, there's the possibility of a recession, which makes it trickier to decide if it's a good idea right now to buy shares of a company that's supposed to sell EV cars. Well, no longer supposed to, of course, because Mullen actually sells EV cars, even though just a few of them. Unlike other fancy tech companies like Palantir or even what Rework tried to be, Mullen is seen as a company that makes things and sells them to people. They can't really afford to lose money for too long of a time. Plus, if the economy doesn't do well, fewer people might want to buy EV cars, like the ones Mullen makes, because they tend to be more expensive than the regular cars. Then there's the issue of global problems, like conflicts, trade issues, and other uncertainties. These can shake up the financial markets real good. When that happens, investors often look for safe havens to put their money into, like blue chips, commodities, and government bonds, and they tend to avoid companies like Mullen because of their risk profile. All these factors can make penny stocks like Mullen jump around a lot in price and make people uncertain about when or whether they should be buying them. When interest rates go up, investors might get more careful. High inflation can be a chance for some, but a danger for many. And when there's a talk of recession, investors might choose safer things to invest in. It's just logical and part of human nature. Being honest and open about how a company is doing is also really important, especially for penny stocks. And in this aspect, I would say that Mullen isn't really a reference, unfortunately. Smaller companies often don't have the same rules or the company culture to report everything as transparent as the bigger ones or the more established ones do. Investors usually don't want to mess with penny stocks, especially in the long term, because they're not really clear about what's going on, given the fact that they are already risky. Without clearer information, there's a higher chance of scams, trickery, and market manipulation. The company that gives clear and honest information can really make a big difference in how confident investors feel about trading penny stocks like Mullen, which unfortunately, in addition to all the other problems that it's facing, is not really good at. Personally, I believe that Mullen has the potential to become a meme stock with plenty of volatilities in the short-term future once again, but we should expect the selling pressure to be significant at all time. This means that the time may have come to start buying Mullen shares once again, with the anticipation that Mullen will be able to bounce back from where it is now versus where it could be in the short-term future due to rational and irrational reasons. I would recommend to commit between 0.5 and 1% of your portfolio in Mullen, and would also recommend to split the allocations in 10 to 20% over the next 3 to 6 months in case the stock price retraces even more.